Alright everybody, in this video I will teach you the most powerful PD array that you can use to take your trades, and I will also teach you a trading strategy or a trading model based around that PD array. So the PD array that I'm going to talk about is called the inverse fair value gap, and it is powerful than auto block, fair value gap, or breaker block. This one has to be my favorite one because once it forms and once the pattern occurs, the price is gonna go into your direction most of the time. So what exactly is a inverse fair value gap and how you can trade it? So first off, I'll explain what an inverse fair value gap is, and later in the video I will teach you a trading strategy based around this PD array. So over here, what you can see is that we had a break of structure, right? So we have a lower low, lower high, and then a lower low. Now inside this lower low leg, we will have a fair value gap. So what is inverse fair value gap? Whenever a fair value gap is violated, so in this case, you can see we had this bearish fair value gap after break of structure. So we had a break of structure here, we had a fair value gap here. Now once the candle closes above it, right? Once the candle closes above the fair value gap, this fair value gap becomes violated and it is no longer a fair value gap, but it becomes an inverse fair value gap. All right. So similarly, like support and resistance flips, right? Whenever resistance becomes support and support becomes resistance. Similarly, if a bearish fair value gap is, reclaimed like this and the body closes above it, then that bearish fair value gap becomes inverse fair value gap, or you can say a bullish fair value gap. So now you would simply take your entry on the retest, right? And then you can target your whatever target is there. I'll get later into that in the video, okay? And similarly, if I flip the chart over, you can see that we had a break of structure and we had a fair value gap inside this leg. So we had a higher high, higher low, and then a higher high. And inside this fair value gap, normally you will try to take long, but what happens when price closes below it and violates this fair value gap, right? So this bullish fair value gap was violated and the body closed below it. Okay, now once the body closes, that's when the inverse fair value gap forms. So now on the retest, you are going to take your entry and you're going to target whatever sell side liquidity is resting below here. Now here are some examples. So over here you can see that I have this chart, and after break of structure we have this tiny fair value gap over here. You can see over here, and price just violated it like that. Look at this, the body closed right below this fair value gap. Now once that happens, this bullish fair value gap becomes inverse fair value gap, or in easy words you can say the bullish fair value gap flips into a bearish fair value gap. All right, so this is now an inverse fair value gap. So now your entry would be on the retest, and you could have targeted this inefficiency down here or a fair value gap, whatever you want to say. Over here, you can see that in this example, we take out sell side liquidity, and afterwards, what do we have? Or you could say we had a break of structure, and we then had a fair value gap just around here. You can clearly see, right? A bearish fair value gap. But what happens? Price violates this fair value gap. It does not respect this fair value gap, and the candle closes above it. Now once the candle closes above it, all you're simply doing is taking your entry on the retest. Now once you get your entry, your first take profit could be here, your second could be inside this fair value gap, and your third could be probably over here. So very simple. Over here, what do we have? Once again, we take out sell side, or you can say we had a break of structure and then we had this fair value gap here, but you can clearly see that it was violated and it was not respected, and the body closed above this old fair value gap. So now once the body closes, this bearish fair value gap becomes inverse fair value gap. And similarly, you would take your entry on the retest and you would take your first target on this fair value gap around here, and your second take profit level could have been this over here. So here is another example. So you can see we had a break of structure and then we have this fair value gap around here. You can clearly see over here, just around here. And what happens? Price violates this fair value gap and closes below it right here. Now, once the candle closes, this bullish fair value gap becomes inverse fair value gap, or you could say a bearish fair value gap. And you can see price went ahead and retested this level. And you can see that the bodies were respected. All right. So bodies tell the story. So your entry would have been here. You could have taken probably your first target on this low around here. And your next target could have been this low over here. But yeah, guys, this is very, very simple. And let me teach you guys the trading strategy, and then I will give you examples for that strategy as well. All right, everybody. So here is a trading model or a trading strategy based around the inverse fair value gap PD array. I have uploaded this strategy before on the channel, but I'll go into more detail in this video. So these are the rules of the strategy. So after 2 a.m. New York time, so remember 2 a.m., that's when the Asian session ends, right? I'm not talking about the kill zone, but the Asian session, okay? 2 a.m. You have to look for any type of market structure shift on the 5-minute time frame. Any market structure shift, okay? It doesn't matter where it happens, but you have to look for a market structure shift. So over here, you can see that we have a higher high, higher low, higher high, and afterwards we have a market structure shift. Now, here is the most important rule. Normally, after market structure shift, you will look to take your entry from the fair value gap that is resting here, or an auto block here, but you have to wait for another sweep of this high. So after market structure shift, you have to wait for price to take out liquidity again. That's going to be this high. Now, once that happens, you start looking for a formation of inverse fair value gap on the 5-minute time frame. So if I zoom in like that, you can see that in this leg, we had this fair value gap. So the most recent inverse fair value gap, you have to mark that out. And you then have to wait for price to close below it. So once the candle closes, that's when the inverse fair value gap forms. You then simply take your entry on the retest. You go short like that. You put your stop right above the high, and you go for 1-to-1 risk to reward ratio. Now this is going to have above 65 or 70% win rate if you stick to this rule of 1-to-1. Okay, so let me explain it again in case you missed. You have to look for a market structure shift after 2 a.m. New York time. Once you get a market structure shift, you wait for price to take out the liquidity once again. The liquidity has to be this high, right? It can't be any liquidity but this high. So we have a higher high, higher low, higher high, right? And then a market structure shift. So price has to then take out the higher high after market structure shift. This pattern, look at this pattern and memorize it, okay? Or keep watching this. After market structure shift, we have a sweep of the liquidity, right? Once again, and then we look for the most recent inverse fair value gap that forms, and then we wait for a entry on the retest, and we target 1-to-1 or 1-to-1.5 in most cases when your bias is strong. And similarly, if I flip the chart over, you can see that after 2 a.m., what we do look for is a market structure shift on the 5-minute time frame. So over here, we have a market structure shift. Normally, you would try to take your entry from the auto block or fair value gap from here, but we then wait for another sweep that happens like that. Okay. Now, once that happens, all you're looking for is a most recent inverse fair value gap that forms. So this fair value gap, right, in this leg has to be violated. Once that is violated and the body closes above this, the fair value gap becomes inverse fair value gap. So you take your entry on the retest, put your stop right below this low, and you go for 1-to-1 risk reward. So let me give you guys some examples, and then I will end the video. All right, so here is example number 1. I'm looking at Euro USD on the 5-minute time frame, and at 2, this is when the Asian session ends. So now I'm looking for any type of market structure shift, and you can see we have a higher high, a higher low, and then a higher high over here. And afterwards, if you look very closely, we broke this structure. So that is our market structure shift with this leg. Now, instead of taking my entry from this auto block, I will wait for price to take out this high once again. Now, once price takes out this high once again, I keep marking the most recent inverse fair value gap. And over here, you can see that we have this fair value gap. And if I mark this out like that, you can see that the body closed right below it. So now this fair value gap becomes inverse fair value gap. And my entry is going to be on the retest. My stop would go right above this high. And I would go for 1-to-1 risk to reward ratio every single time. But you can also go 1-to-1.5. In this case, I would have gone for 1-to-1.5 because there was a clear inefficiency down here that I could have targeted. And you can see that price came in right into it. So very, very simple. Let's move on to the next example now. All right, everybody. So here is example number 2. I'm looking at EURUSD on the 5-minute once again. And I highly suggest that you stick to EURUSD and GBPUSD only for this strategy, or you can stick to NAS 100 and S&P 500. So over here, you can see that we have a lower low, lower high, and then a lower low. And afterwards, we have a market structure shift here. Now, a lot of people would try to go long from this fair value gap, right? But notice what happens. It was just rushed through. It just broke through it. So our rule was met after market structure shift. We wait for price to take out this low once again. And once this low is taken out, we start looking for an inverse fair value gap. Very important, we have to start looking for an inverse fair value gap. So over here, you can clearly see that we have this beautiful fair value gap down here. And if I mark this out like that, you can clearly see that price closed above it. So now that would have become your inverse fair value gap here, right? And then entry on the retest, you go for 1-to-1 risk to reward ratio. Very, very simple, guys. It's literally like your bread and butter trading strategy that you can use. Now, here are some key things to note. After market structure shift, so the fake market structure shift, whatever you want to call it, and you have your fair value gap marked out. If you see like a big reaction of this, like something like that, then you do not look for this setup because the move has already been done, right? So you want to see like an instant break through this fair value gap into this purge of this low. I do not want to see price come into the fair value gap and give me a push like this. That's going to just invalidate the setup. So I hope that makes sense, but that's pretty much it. You look for a market structure shift. And once that market structure shift happens, you look for a purge of the market structure shift leg low. That happens right there. Afterwards, you start looking for a fair value gap that forms, and that or the most recent inverse fair value gap. In this case, we first mark the fair value gap, and once the body closed above this fair value gap, violating the bearish fair value gap, this fair value gap becomes inverse fair value gap. And then our entry would be on the retest. We target 1-to-1 or 1-to-1.5. Considering the fact that our entry was here, you could have targeted this fair value gap over here, giving you 1-to-1 at least. And yeah, guys, let me give you guys one more example, and then I'll end the video. All right, everybody. So here is another example. So as you can see, the Asian session ends at 2. So we then start looking for a market structure shift. And over here, what do we have? We have a clear market structure shift, right? Now, this is our auto block. And normally, a lot of people would try to go long from this auto block. What happens? Price takes out the low of the market structure shift leg. And once that happens, we start looking for inverse fair value gap formation. And you can clearly see that over here, we have this tiny little fair value gap just around here. If I drag this along like that, you can clearly see that the price violated that fair value gap, the bearish fair value gap. And once the body closed above it, this fair value gap becomes inverse fair value gap. So my entry then would be on the retest of this. My stop would go right below this low, and I would go for 1-to-1, and that was a beautiful take profit level hit. But there was a fair value gap up there that you may have targeted. Now, if you're good with risk management, you can do these type of experiments. So that's what I'm giving you 1.73 risk to reward ratio. That would be it for this video, guys. I really hope you guys enjoyed this video and learned something from this. Go and backtest this strategy and backtest the inverse Rayleigh gaps. They are the most powerful PD arrays that you will ever find. They work like a charm, and once your direction is clear, just like that, you're gonna get like insane results. Thank you so much for watching. Please hit the subscribe button. I'm giving away so much information for absolutely free. I at least deserve a subscribe. Please do it, guys. Come on. 1, 2, 3, 4, 5. Okay. Thank you so much. See you guys next weekend.